over the last 4 to 5 years, we have now built active relationships with 700 Series A and above startups in the country. And the metric by which we are looking at ourselves is that how relevant we are for this ecosystem. We are helping companies raise capital. We are helping companies process their transactions. And we are providing them a safe house for the surplus capital that they might be having, right? So across these 700 startups, we today have around 25,000 crores of liabilities across fixed deposits, current account balances, savings account balances of their employees. We've also lent to the extent of 2,000 crores. Our objective we are not chasing a target. The only target that we are chasing is that how many startups are we banking? Right? How many startups call Axis as a relevant and a core banking partner? That's the only target that we are chasing. The book size, liabilities, lending, or the profits that we make out of that is all incidental. Yeah.
How is Axis Bank's offering different from the venture debt out there? You're providing debt, which is sort of the in-between round of two fundraisers, sort of the runway before the next equity fundraise happens for capital, typically for these startups. Just tell us how it compares, how your interest rates are different. Give us some sense of where Axis Bank stands.
So look, I think credit is provided to the most promising candidates in this ecosystem. And if the startup has scaled up well, or they have created a business model where they have reduced their losses, etc., we as a bank, when we are providing credit, we are reducing the cost of credit for them, right? And the savings that they get by borrowing from us goes directly into their P&L. And that's the difference that we are providing. Venture debt is a different asset class. They have a different regulator. They do not raise liabilities from people like you and me, right? They raise money from HNIs. They raise money from family offices. They raise money from endowments. A lot of funds who are registered at venture debt providers have offshore LPs, right? So that's a different investor class. And they are able to take a much higher risk, and that reflects in the cost of capital that they provide.
So what is the typical difference in the cost of capital that Axis Bank is provide versus some other venture debt provider?
This would be anywhere between 200 to 300 basis points.
Sure. Okay. Banks typically do not lend to startups. That's what we've seen. You also have a very small lending book. It's only about 2,000 crores. Just tell us how you ensure that you're doing the right due diligence to minimize the risk on your book, because inherently one of the big reasons that banks have traditionally stayed away from this business is because of the lack of, sort of financial records, etc. And, the risk element is slightly higher. What are you doing in terms of your due diligence to ensure that the book is protected?
Right. So, first of all, we lend only to Series A and above funded startups. So by that time, the startup has progressed beyond the seed angel round, and now they have institutions sitting on their cap table. The fact that an institution has come on the cap table would hopefully lead to further capital raises as and when they need capital going forward. So that's the starting point. And then for us, the track record of the founder, the business model, all of that is very, very important for us. Then we finally come down to the numbers and the financials. The structures that we typically work with is, let's say, a startup has provided a service or sold goods to their customers. They have sold on credit. So we fund the debtors. And then as and when they collect money from their customers, that goes on to reduce our borrowings, and then we give them fresh lending, right? Likewise, we would fund them against inventory, and as and when they are selling their goods out of the inventory gets converted into cash. That cash is used to reduce our borrowing, right? So we have these self-liquidating structures, which we do, and these are time-tested structures. Over the last 4 to 5 years, we have kind of fine-tuned this model, and it's worked well for us.
Well, within your risk parameters, are there specific segments within startups that you're more excited about or that you have a higher exposure to? And where do you see most of the demand for debt from these startups coming from?
Right. I think what we try to do is that if suppose a lot of these startups are pre-profit companies, right? So we look at the burn that they are doing. And if the burn is reducing consistently, we wouldn't necessarily wait for the burn to become zero. And if we see a sustainable path to profitability, if we see the management of the startup having done the right management actions for the startup to become sustainable, that's the time where we will come in, and we'll probably help them become sustainable by providing a cheaper source of capital, and that's the way we kind of get in. Yeah.
Sure, but what are the sectors that you're most excited about, and what are the sectors where you're seeing most demand for debt at this point of time?
So look, I think e-commerce, D2C, agri-tech, these are fintech, these are some of the spaces where, we have seen demand for credit coming through. Yeah.
Okay. Also going ahead, while you can't give us a target in terms of how large the book could grow,
right,
but what are your aspirations internally? Will the focus remain on building the liability side of the business?
Right.
Or are you looking at a larger lending book sometime in future, and how large could it be?
So, I think, as I said, our target market is Series A and above startups. So if you look at in the country today, there are anywhere between 1,500 to 1,800 startups, Series A and above, and who have done at least a fundraise over the last 3-4 years. That is our target market. Today we are at around 700 active relationships. We would want to take it to, let's say, around 1,200 in the next couple of years, right? So that's the way we are looking at it. And when we bank these startups, we also bring the entire franchise together, right? So it could be also a situation where Access Capital is helping some of these startups go public or helping them raise funds. So that's also part of the overall relationship that Access is building.
Sure.
With these startups.
And finally, across the credit cards that you offer to these startups and the 2,000 crore lending book that you have,
right,
how has the book performed in terms of delinquencies? Have there been any write-offs? Just give us an overall sense of where the book stands.
We've not had any write-offs or, and delinquencies, of course, I think they could be a little bit here and there going, but yeah, so it typically, we haven't seen delinquencies go beyond 30 days at all. Okay. So it's a very well-behaved book. And essentially, that's because of the client selection that we do and the upfront diligence that we do. We also have a very deep penetration into the ecosystem. So a lot of trends we are able to see in this ecosystem well ahead of they coming out in the public domain, and that helps us take correct